Marissa, it was a big year for ETFs in 2025, both active and passive. How do you think investors are going to be utilizing ETFs in 2026?
Great question, Greg. 2025, as you said, was a record-breaking year for ETFs across all metrics. So flows, assets, launches, and volumes. And I think that will continue into 2026. One of the sort of emerging themes that we've witnessed in the space is the rise of active ETFs. And this is an area where what we've noticed is that they comprise around about 11% of assets, and yet they've captured 32% of flows last year, and they represented 86% of new launches. And so this is a trend that we're definitely watching closely.
Can you dig a little bit deeper as to why investors and advisors are choosing actively managed ETFs right now? Because when ETFs first came up, it was all about being passive. In the past few years, actually, the indexes have done extremely well. So why do you want to be active?
So I think investors are really expressing a desire to combine the benefits of active management, in other words, the professional security selection, the robust risk management, dynamic portfolio positioning, with the benefits of the ETF wrapper. So the tax efficiency, the ease of trading, the transparency, particularly versus mutual funds. And so this is a way that investors can really have the best of both worlds.
Derivative income ETFs were also big last year. Do you expect that to continue? And why? People just like that yield?
So we do expect derivative income ETFs to continue to be in demand this year. They were actually the number one flow gaining category within active ETFs last year. And I think this is a trend that we'll continue to see. One of the reasons for their popularity is because they offer investors not only a high attractive source of income, but they also offer a lower volatility form of equity exposure. And our premium income ETFs, GPIX and GPIQ, have been particularly popular with our clients because I think they offer an additional benefit in the form of an actively managed call writing overlay strategy. And what that's really meant is that we haven't had to cover the entire portfolio. We dynamically adjust our portfolio coverage as market conditions change. And so that has allowed our investors to have greater participation in equity market upside.
Defined outcome ETFs also had a big year in 2025. Once again, why should investors get involved with this when you have these passive index ETFs doing so well?
Another great question. So defined outcome ETFs, that was also a big flow gainer last year, and another trend that we expect to continue this year. Defined outcome ETFs are very interesting. They allow investors to retain equity exposure, but they reduce the variability of outcomes. So they offer investors a predetermined outcome within a defined range. Now, I think any investors can buy and use defined outcome ETFs. I view them as an additional tool in an investor's toolkit. But investors that want to target a specific risk profile, for example, or that just want to retain equity exposure, but don't want to stomach, the full volatility of equity markets, particularly given the current environment of elevated market volatility and uncertainty. I think this is a great investment tool.
And then finally, if you want to reduce the uncertainty in a portfolio, you could also buy a fixed income ETF. I know we've been talking about varieties of equity ETFs. So what are your thoughts on fixed income ETFs heading into 2026?
So this is a really interesting area of the market. You'll know that the ETF industry is dominated by passive, number one, and number two, it's dominated by equity. So when we look at the overall ETF industry, only 17% of ETF assets are currently in fixed income ETFs. And actually, when we look at active fixed income ETFs, that number goes down to 3%. So they are massively underpenetrated. Then when we look at the fixed income market and we think about the scale, the fragmentation, the structural inefficiencies of the fixed income market, that's when we realize how much the ETF vehicle can bring in addition to active management. So I think the asset class lends itself to active ETFs. One area that we're seeing particular opportunities right now is in municipal fixed income, as an example. And so, but I do think that you need to go active. So a product like GMUB, which is our National Municipal Income ETF, allows our investors to capitalize on opportunities in the municipal sector, where we see credit fundamentals as strong, we see spreads as pretty attractive as well. But because we're actively managing the ETF, and we've got a dedicated 10-person strong research team that are doing this all day, every day, it allows us to really pick and uncover those opportunities in the space.
All right, well, thanks for coming on and talking about it.
Thanks for having me.